So I have been investing £10 every single day into the S&P 500 for 89 days now, and this is how things are going. So I decided to invest into one of Trading 212's cheapest S&P 500 funds for UK investors. This is the SPDR S&P 500 UCITS ETF. This is an accumulating fund, which means that the dividends are reinvested back into the fund. Now this has the ticker code SPXL, and this is not a recommendation for this fund. Always do your own research. Now I began investing on the 12th of May. As you can see, not all-time highs. This was a few weeks after the massive dip that we saw. You can see the worst of it was around April 2025. Now since then, as you can see, things are looking a lot better. There was almost a full recovery. Unfortunately, the SPXL does not show a full recovery, even though the actual S&P 500 index saw a full recovery. Now what I mean by the actual S&P 500 index, it is this index that you can see on things like Google Finance or Yahoo Finance or pretty much any financial website. Things look extremely different in my opinion. This is a year-to-date representation. Now over the past year, this is how it looks on the actual S&P 500 index. You can see there was a massive dip. The worst of it was around 7th of April 2025, and then you can see a massive recovery by well over 25%. So going back to the SPXL, you can see a different profile here, almost the same. Over the past year, you can see a massive dip. The worst of it was on about the 17th of April, a little bit different for us. And then we can see a nice recovery, but not a recovery to all-time highs. Now this is because this S&P 500 index allows us to invest into pounds, and between the pound and the dollar, which American companies in the S&P 500, they use dollars. Between those two currencies, there is a difference. So unfortunately, during that time period, the differences between the pound and the dollar, they made it so that we didn't get a full recovery here. Now, in the opposite vein, you can see over the past month, this fund is up by 3.45%. But with the actual S&P 500 fund here, you can see it's not up as much, and that is because the pound has been weakening against the dollar. So exactly how has my investment been going? Like I said, I invested £10 every single day. So it's been 89 days since the 12th of May. Over the weekends when the stock market is actually closed, what happens is I put it into a pie on Trading 212. So even on Saturdays and Sundays, £10 is put into that pie, and on the next working day all of that money is actually put into the stock market. So usually you'll see on Mondays there is a bigger deposit into the S&P 500. Unfortunately, there is nothing we can do about that. The stock market is only open 5 days a week. Now like I said, I started on the 12th of May 2025, and as you can see here, my average buy-in price was £10 and 74.4 pence. So if we want to compare lump sum investing with dollar cost averaging, if I had lump summed £890 into this S&P 500 fund 89 days ago, I would have got myself 82.84 shares in the SPXL. Now this is going to be very important in our comparison because we'd rather compare the amount of shares that we have so that we can easily do a comparison, because otherwise the share price does change very frequently. Now if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you already signed up to Trading 212 in the past 10 days but have not received your free fractional share, then all you have to do is to press the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this section, just enter my code JUBAIR and you should receive a free fractional share. So as you can see, this is a custom pie I made, called it the S&P 500 £10 daily. You can see by my net deposits that I have deposited £890. So that's £10 every day for 89 days. I would have made it 90, but tomorrow is a Saturday and we're not really going to get anything invested on a Saturday. As you can see on this Trading 212 pie, I have Autoinvest enabled, which allows me to daily invest £10 into the cash of this pie, and then automatically, if the markets are open, that cash is used to invest into my selected fund. So as you can see over the past month, it pretty much is a projection just upwards. The S&P 500 has been climbing quite a bit over the past month. Now when I change that graph to 3 months, you can see pretty much all has been a nice upward swing apart from here. On the 1st of August, there was a little hiccup, and then it seems like the S&P 500 got back on its toes. So in total, here is my return, investing £10 a day for 89 days, and that return is a positive 4.83%, and that is a rate of return in terms of pounds and pence of £42.96. Now, essentially, that is 4 days worth of deposits that I'm getting for free. But remember, this is completely unrealized. This can all come down very easily. There's no guarantees in the stock market, but I think over that time period, not too bad of a return. However, did it really make sense to be investing every single day, or would it have made more sense if I had just invested £890 there and just left it? So this is what we're going to be finding out. So with my SPXL, if I scroll down here, you can see that the value of my investment is £932.96. But more importantly, you can see the number of shares that I have is 80.33. Now remember in the beginning when we said if we had lump summed £890 into the SPXL 89 days ago, we would have had 82.84 shares. Now, we saw in the previous update after 60 days that it was pretty close between, lump sum investing or dollar cost averaging. This is an extreme version of dollar cost averaging, I have to admit, £10 every single day. Usually you would do it maybe a week or every month, which is the most regular, I would say. So yeah, if we had lump sum invested 89 days ago, we would have had more shares. We would have had about 2 more shares. And in terms of pounds and pence, we would have had £962.02. So we would have been nearly £30 better off if we had lump sum invested. Now, given that our total return was £42, another extra £30 would have greatly improved our return on investment. So over the past 3 months-ish, which is around 89 days, we would have been better off over this time period if we had just lump sum invested into the S&P 500. Now, when we look at this graph, it does make sense that if the stock market is going to go up, then a nice lump sum would benefit more from catching those prices that are increasing. However, in a volatile market, maybe dollar cost averaging would have benefited us because we are buying regularly during highs and lows, and we can often reduce our average buying price, although it doesn't always work like that. Now, personally, if you asked me, I would always lump sum instead of trying to dollar cost average. Remember, if you are investing every month with your salary, technically that's not dollar cost averaging because you don't have the cash until you have it, and what you are doing is lump sum investing. Dollar cost averaging is what we're doing here. We clearly have the cash, but instead of putting the cash into the markets all in one go, we purposely make the decision of spreading that out in smaller increments. So make sure to check out some of my other videos, and I'll see you in the next video.